ahead here to next week's midterm elections and the big Fed meeting. Can this rally really continue? We want to ask Keenan Hauke, President and CEO at Sentinel Asset Management, which oversees $23 billion. Also, Keenan Hauke, CEO at Samex Capital Advisors. Good to see you guys. Keenan, what do you think? Is this rally going to continue?
Well, short term, we're going to head into a period of time where we could see choppy market action with a little bit of a downside bias. Really, I'd like to see some kind of a pullback in the range of 3, 4, or even 5% from recent highs. That would be fantastic. But either way, we think the market's heading higher. We think it continues to trend continually all the way through now until the end of January. The S&P takes out the April 23rd high of 1220, and it could be with some authority by the time it's done.
And Keenan, you say that stocks are the best place to be for the next several months. You're not seeing a lot of risk right now in equities?
No, we're a fairly low-risk environment. My biggest area of concern right now, Trish, is the bond market, the fixed income securities, where Americans have been piling money on top of money all calendar year, and in my opinion, they're about to get burned. We see bond prices moving significantly lower over the next couple of years. We think in the last couple of weeks, the fixed income market has actually begun a long-term bear market.
Okay, Christian, I want to talk here about the possibility of some additional quantitative easing that we might see next week. You're actually saying this move is going to be reckless and desperate. I like that. Why do you say it?
Well, it's desperate because it's really the last tool that the Fed has at its disposal in the sort of tools of monetary policy, and it's reckless because I think it will trigger off not so much a round of lower rates leading to, for example, better housing market or better loan demand, but asset price inflation. The money that ends up buying securities will end up in banks and will go straight into the riskiest assets, which will be the stock market, short term, so there's some upside support for that, but most of it will flow right out of this country in the form of a weaker dollar and a rise in emerging market equities. So I really think it's kind of the last hurrah in terms of monetary policy from the Fed, which is just out of ideas.
So, Christian, how would you protect yourself against this?
Well, I think, funny enough, I disagree with the last speaker because I think bonds are actually going to be a good place to be. Here you've got a buyer of first resort coming into the long end of the market. So they're not going to be in the belly of the curve in the 7 to 15 range because that's where most of the central bank buying from overseas is going to occur. They're going to be at the long end of the market, so that's where duration is really going to be in investors' favor. So the 30-year yield's about 4.1 right now, and we still think with the QE that could come down to well under 4, so it begins to be had in the bond market. And I think in the equity market, the best way to protect yourself is buying companies with strong balance sheets, good dividend yields, and very importantly, growing dividend yields. And there's plenty of those to be had right now because we think the markets are woefully undervaluing the cash and the dividend stream from equities.
You know, Keenan, I know you're on the opposite side of this, but I think there's one thing probably everyone's going to agree on, and that's that the dollar is going to continue for the foreseeable future. As long as the Fed keeps printing money, moving lower. Keenan, let me know if you disagree, but with that in mind, how do you protect yourself against this lower dollar?
Yeah, we have a feeling that the dollar is going to continue its downward slide, but that's exactly why you have to position yourself, Trish, into these riskier assets. The dollar goes down, it's going to create this inflation, whether it's asset-based, which I agree with, but we also see it coming into everything that we live off of. We see all the basic commodities hitting multi-month, multi-year highs. If you're going to keep up with this, you've got to make some investments that might be considered risky over long term, but for the next few months and possibly the next year or 18 months, they're not so risky. You want to keep up, that's how you have to do it. You've got to be in the stock market.
So given that you're both agreeing that the dollar is going to continue moving lower, is there a play there for an investor? Keenan, I'll let you take that one first.
Well, sure, you can short the dollar. You can go long the euro through different ETFs.
Doesn't feel too crowded to you?
What's that?
Doesn't feel too crowded to you?
Well, I'm not a commodity or a currency direct player. I'm in the stock market either long or short on any given basis. So that's where we're going to make our money. But if you ask directly, yeah, you can short the dollar, you can go long the euro, you can go long some of the Asian currencies, even Australia. I mean, look at the Australian dollar against our dollar. It's been doing fantastic the last several weeks.
You know, Christian, what about that diversifying yourself so that you're not dependent entirely on the U.S. dollar, perhaps even looking at some multinational U.S. companies that have their hands in many different countries?
Exactly. I mean, that's one very good way to do it. So buying stocks like Schlumberger, Nike, Exxon, these type of stocks have a large portion of their sales come from the overseas markets, and they typically don't hedge those currencies very far out. So you're going to get some currency kicker that way. So that's one way to do it. Another one is certainly to buy gold, because the gold price is going to be very, very centered to the dollar weakness, and then we see some upside in that. And I think the other way is to go directly into emerging markets, because most of the currencies in the emerging markets are are undervalued by traditional means, and I think that eventually will correct itself and be well protected there.
Christian, what's your reaction to today's GDP number?
Well, I think it's weaker than we thought, and I'm a bit worried about the revisions down, because remember in the second quarter we started I think about 2.6 and ended about 1.7. So these revisions only go one way. So we're out here at 2, and it doesn't really look like there's much in there. And other than the inventory rebuild, which is a kind of a classic again, cycle, a very volatile part of GNP, I don't think it's very good for for final demand in the real economy. So I think we're good at 1.5-2% GDP for quite some time, which can make no dent whatsoever on the unemployment numbers.
Keenan, I'm curious about your reaction as well, because some people actually saw this as a positive sign. They were happy with the 2%. Your take?
Well, the GDP numbers, employment numbers, all the macroeconomic situations that we're dealing with, and we will deal with for some time, are going to make these economists absolutely wring their hands, because they're going to see lower numbers on GDP, they're going to see consistently high numbers on unemployment, and yet the stock market, it's going to keep grinding higher, and not going to know what to do with that. It doesn't fit their models, and yet it's going to happen.
But Keenan, what if QE2 disappoints? I mean, there has been talk of that they not need to be
I kind of hope it does, so the stock market gets hit a little bit and I can do some buying. It doesn't matter the type of thing. We have an airline situation that 6 months ago could have crushed the market, and yet it ends flat. Bad news is not denting the market whatsoever. This stock market wants to go higher. So buy the dips and keep with it.
Guys, we just had Nouriel Roubini on, and he was saying that he thought gridlock was actually something that would be bad for the economy. He mentioned specifically his concerns over mounting debt and growing entitlement programs with no real
plan.
Bad
for the economy. You shut these guys in Washington down, I'm going to be throwing a party.
Well, I wanted to get your reaction, because a lot of investors say, hey, gridlock, bring it on.
Bring it on. We have got to shut the regulators down. We've got to put a stop to these people. Business owners all over the country, they're crying about the overabundance of regulation in their lives, and it's putting a stop to them. Now that we know better, friendly business people are coming in, we're going to see business people start to spend more, employ more people. That's why the Dow's over 11,000 and not under 10.
Christian, you like gridlock?
No, I mean, let's get serious about this. Having a congressional legislative body in gridlock is not good for the country. And it might seem that sort of an impasse is going to be good. There'll be no change on taxes, that they won't sort of be at each other's throats. They'll be left for the private sector to get on with it. But the private sector can't get on with it. It has shown for the last 2 years that the market having